everyone, and welcome back to the channel. Get ready, because Warren Buffett's empire, Berkshire Hathaway, just dropped its latest earnings report, and the numbers are truly eye-opening. We're talking about a massive write-down, a surprising dip in overall profits, but also some unexpected wins that have Wall Street actually cheering. But here's the absolute kicker. I'm going to tell you why one major financial firm believes this legendary investor might be setting up his next giant move, potentially defying what's known as the August curse for the stock market. You won't want to miss the details on that at the very end of the video, so make sure to watch until the very end. Let's jump right in. First off, let's talk about the headlines. In the second quarter of this year, Berkshire Hathaway's total profit fell by more than half, or about 60%. That's a huge drop, with net income landing around $12 billion compared to roughly $30 billion last year. Sounds dramatic, right? The main reason for this sharp decline was a nearly $4 billion write-down on Berkshire's massive investment in the food giant Kraft Heinz. Berkshire owns about 27% of that company, and unfortunately, it's been a tough ride. Warren Buffett himself has admitted that he overpaid for that investment back in 2015. Kraft Heinz has been struggling because people are changing how they eat, opting for healthier foods or buying less expensive store brands. In fact, Berkshire's representatives recently resigned from Kraft Heinz's board of directors, and the food company is even looking into selling off some of its famous brands. This $4 billion hit is actually the second big write-down Berkshire has taken on Kraft Heinz since 2019. Now, despite that big hit, here's the silver lining. Warren Buffett always tells investors to pay attention to operating profit because it shows how well the actual businesses are doing, not just stock market ups and downs. And by that measure, Berkshire's operating profit only dipped about 4% to roughly $11 billion. What's even better, that figure was actually higher than what financial experts had predicted. So while the total profit numbers looked scary on paper, the everyday businesses are holding up better than you might think. Total company revenue for the quarter was also down slightly by a little over 1% to around $92 billion. So which parts of Berkshire's empire are shining, and where are they feeling the pressure? Let's start with their insurance businesses. Overall, underwriting profits were down a bit. This was partly due to some big payouts, especially from the California wildfires earlier this year, which cost them hundreds of millions of dollars. However, their giant auto insurer, GEICO, actually reported strong profits, up a little over 1% for the quarter. Experts are very optimistic about GEICO, expecting even better profits going forward thanks to improvements in their systems and pricing. Then there's the railroad business, BNSF, which was a clear winner. Its operating profit jumped an impressive 19% to roughly $1.5 billion. How did they do it? By cutting costs and hauling slightly more shipments. Even with the economy slowing down, BNSF is operating very efficiently. Many of Berkshire's other diverse businesses, like their energy, manufacturing, service, and retail operations, also generally saw higher profits compared to last year. Their energy company specifically saw its net income climb about 18%. Now, for something that's impacting almost everyone, tariffs. Berkshire Hathaway is openly warning that President Trump's trade policies and tariffs are creating a lot of uncertainty. They say these tariffs could negatively impact most, if not all, of their operating businesses and even their stock investments. The company noted that the changes in international trade policies have really picked up speed in the first 6 months of this year. Some of their clothing and toy brands, for example, have already experienced sales declines and shipping delays because of these trade tensions. All right, let's talk about the man himself and the future of this colossal company. Warren Buffett, the 94-year-old Oracle of Omaha, made a big announcement earlier this year that he's stepping down as CEO at the end of 2025. This marks a new era for Berkshire Hathaway. Taking the reins will be Greg Abel, who is currently the vice chairman overseeing Berkshire's non-insurance operations. Buffett will remain as the chairman of the board. Abel is known for being incredibly disciplined and operationally focused. His priorities include making capital more efficient and reevaluating underperforming businesses. This approach means he's likely looking to sell off older, struggling investments, which could include the rest of that Kraft Heinz stake we talked about earlier. One of the most talked about aspects of Berkshire Hathaway is its massive cash pile. The company is still sitting on a staggering about $344 billion in cash and short-term investments. It's slightly less than what they had at the end of March, but it's still near a record high. So why isn't Warren Buffett spending all that money? He said repeatedly that he just isn't finding attractive deals right now because company valuations are simply too high for his standards. He wants to buy companies that are strong, but selling for less than they're truly worth. Another point that might surprise some investors is that Berkshire Hathaway didn't buy back any of its own stock in the second quarter or the first half of this year. This is even though Berkshire's stock price has fallen about 12% since Buffett announced his retirement plans. The reason, according to experts, is that even after that dip, Berkshire's stock is still trading at a premium compared to the true value of its businesses. Buffett only buys back shares when he believes they're undervalued. Now for the big reveal I promised you at the beginning. This is where things get really interesting for Berkshire's future. There's a lot of talk buzzing in the railway industry right now. A rival railroad company just announced a massive plan to merge with another, potentially creating the first coast-to-coast railroad in the U.S. This has sparked speculation that Berkshire's own BNSF railway might need to consider a merger with an eastern railway, like CSX, to stay competitive. However, experts say that Warren Buffett won't just jump into a deal because the market thinks he should. He sticks to his principles, only buying companies that he believes are undervalued. And right now, CSX is trading near its highest value in a year. But here's the exciting part. One major financial powerhouse, UBS, is incredibly bullish on Berkshire Hathaway. They believe Berkshire is uniquely positioned to break what's known as the August curse. That's a historical trend where the U.S. stock market often underperforms due to high valuations, economic uncertainty, and seasonal selling pressures. UBS has even raised their price target for Berkshire's Class A stock, predicting it could reach an astonishing about $892,000 per share. Why are they so positive? It comes down to a few key reasons. 1. Undervalued giant. Despite its massive size, Berkshire's overall value, that's how its stock price compares to its earnings and the value of its assets, is actually historically low. This provides a significant safety net for cautious investors, making it a safe haven during volatile times. The power of the cash. That staggering $344 billion isn't just sitting there. It means Berkshire has incredible flexibility and potential. They could use it for a massive, elephant-sized acquisition, which Warren Buffett loves to do. Imagine the kind of company they could buy with that much cash. Or they could use it to expand their current investments or eventually buy back even more of their own shares. Built for any economy, Berkshire's business model is incredibly diversified, meaning it has strong businesses that perform well no matter what the economy is doing. If the U.S. economy is booming, their manufacturing and railroad businesses will soar. But if things slow down, that massive cash reserve, along with their stable insurance businesses and utilities, act as a powerful defensive shield, underpinning the company's performance. This offense and defense capital strategy is a cornerstone of Buffett's long-term success. High-quality holdings. Berkshire's stock portfolio is filled with industry leaders like Apple, Coca-Cola, and Amerex. These are companies known for strong cash flows and durable competitive advantages. This overall investment style and diversified business layout means that Berkshire's stock price volatility is much lower than the broader market, and it often performs better during periods of market weakness. In essence, with its new leadership, strong underlying businesses, and unparalleled financial strength, Berkshire Hathaway is built to navigate any storm and potentially deliver long-term resilience, even with the short-term bumps we've discussed today. And that's the latest on Warren Buffett's Berkshire Hathaway. What do you think about these results and the future of the company under Greg Abel? Let me know in the comments below. If you found this video helpful and want more insightful financial content, please hit that like button, subscribe to the channel, and don't forget to ring the notification bell so you never miss an update. Thanks for watching, and I'll see you in the next video.